Let's now take it across then to Ridham Desai in conversation with Nikunj to talk about what to expect from the budget as well as for the markets. Nikunj, over to you.
What other words do you think this time we are likely to use post the budget? Another budget, big bang, excitement or disappointment?
So Nikunj, the budget generates more TRP than economic momentum. At least that's what I have observed over the years. I mean, after the 91 and 92 budget, incrementally, they have not been such major policy documents. Policy is a all the year round affair. So it's not concentrated on a single day, on a single morning of the budget. Nevertheless, the market focuses a lot on it. At least it seems so. But when you look at stock market performance of the last, say, 25 years, the impact of the budget is waning, both in terms of the volatility it generates, so for day traders, as well as of the lasting impact it generates on share prices. So, with that backdrop in mind, clearly there are expectations that the government will use this platform on Saturday to continue with the recent momentum we have seen on the policy front, which started in, say, August last year. Therefore, I think there is some expectation around it. So what can happen? Well, firstly, I think the most important thing is what is the fiscal target. But even more important than that is how credible the numbers are. And that, this has been all over the place over the past several years. Successive governments have intended to consolidate the fisc. And clearly we have struggled a bit on this front. The targets have been missed. And we have delayed the consolidation. Now, we're looking at 3% over the next couple of years. I think this year may not be that year we get there. Clearly, the trailing 12 months, there is going to be some slippage because of the tax cuts and because of the overall slowdown in the economy. So I think from there, maybe we get some consolidation, but I don't expect a whole lot. The second is, what the government does with its expenditure. I clearly see the need to boost consumption or boost economic activity. So I'm hoping that there is increase in transfers to farmers. The government has a very good scheme in place where it is transferring cash to farmers, which was launched in December of 2018, or rather in February 2018 with February 2019 with retrospective effect from December 2018. I hope that scheme is enhanced because clearly there's pain in the rural sector and this is a direct way of addressing it. Of course, the government has already talked about boosting infrastructure spending, so we'll wait for some more details in the budget. Then the second thing is what it does with taxes. There's clearly room to rationalize taxes, and I'm hoping again, I don't know if I can say I'm expecting this, but I'm hoping that there is attention paid to capital markets. Whether it's dividend distribution tax, whether it's long-term capital gains tax, I think there's scope for us to rationalize these, and this may be a good year to do that. With that direct implications on share prices and, of course, the economy. Because remember, share prices reflexively act on the economy as well as the other way around. So it's not just the economy that influences share prices, but even share prices influence the economy. And maybe the third area that we should be looking at is, how the government wants to tackle, monetizing its balance sheet, what we call as privatization. Because clearly resources are constrained with the current economic backdrop, and therefore there is greater monetization of the balance sheet needed. I think they should get really aggressive about this. 2001 to 2003 is a good template to use when the erstwhile NDA government under the leadership of Vajpayee and Arun Shourie had launched a massive privatization program. So I think that's the type of privatization program I'm hoping gets launched for the next 12 to 24 months. And that will give the government much needed resources to heal the economy and to undertake more tax reform.
Ridham, Aisha and me have just finished our breakfast. I had a coffee, so I got my caffeine shot. She had a green tea, so she was able to detox. Now the country is getting a detox because of the other reforms which have happened outside budget. But right now the economy needs a caffeine shot, which means more money should reach the consumers. What could be that caffeine shot in this budget?
So So see, I think Nikunj, it's not about providing caffeine shots because those, fade away very quickly. What I think you need is a greater focus on structural reform. And there's a lot of low-hanging fruit on that front. And it's not the budget that, is the platform for doing this. I mean, you can make the announcements there, but really the action has to happen on a daily basis. So whether it is, liberalizing the investment environment, whether it is making investments more viable, whether it is actually getting manufacturing companies to start setting up capacities, those are the things I think that will actually revive the economy on a more sustainable basis. Yes, you can throw some money around and hope that people will spend it, but that's not actually going to create a sustainable recovery in the economy. What we can also wish for, and I think that's the Morgan Stanley view, is that there will be a modest improvement in global growth. Of course, there is this virus risk out there, and I hope that it fades away. And we have to keep a great vigilance about it because it has the potential to spoil what has been a nascent economic recovery. And people underestimate the role of exports. We've been talking about this for a while. India's share in global exports has been stagnating for the last 6 or 7 years. On a physical plus services number, it is about 2%, and that needs to go up. Because if you want greater economic prosperity, you need to trade with richer people. If poor people are trading amongst themselves, that is, if we remain a domestic economy, we're not going to actually create prosperity. So it's very imperative that we go out and trade with the rest of the world. So you need trade deals out there. You need a trade deal with the US done, with Eurozone done. So I think these are things which are outside the budget, which are far more sustainable in creating economic growth and prosperity than single cash shots thrown at consumers. Also, don't forget, come August, there's a massive refund that's coming the way of the middle class, which was announced again in the February 2019 budget. I think if I remember correctly, it's about 20,000 crores, which will come in the form of refunds to middle class taxpayers. So there is already that pending stimulus that is coming in August. So I think there's more need to do structural reform. Save for the fact that I think farmers need to get greater attention, as I mentioned at the outset. And the reason I'm saying this is because food prices have been very well contained by this government over the last 5 or 6 years. Now, one of the fallouts of that is that the terms of trade in this country are transferring the wrong way, which is that it is going from the farmer to the middle class or the upper classes in terms of income. That's what I mean by classes. Whereas it should actually be going the other way, which is that richer people should be transferring terms of trade to farmers. So now how do you reverse that? You can't lift food prices because food prices then create generalized inflation and everybody suffers. So I think the best way to do it is through these cash transfers. And it is now possible because the infrastructure is in place due to Aadhaar and DBT. So I would only focus on that segment for throwing cash, but not general consumption. I think you rather work on structural reform and save your bullets for those rather than spend your money away. And therefore, infrastructure is a much better area to spend and create jobs than to just throw cash into the consumer's pocket. Sorry, it was a long-winded response, but I hope it conveyed the point.
Yes, it did. I mean, the whole point on inflation, I think, has come out very well in this answer of yours. So my next question, Ridham, is about what markets thought the bent of the government was. When tax on buyback was introduced and when surcharge on super rich came through, the sense which a lot of us, including members of press and investors, got that is this government anti-rich? Is this government against wealth creator? So do you think more than anything else, it's the attitude and the whole tonality of the budget in terms of what the vision is will matter? Because that's the last thing which you want the budget to project, that they want to tax the wealth creators more.
No, fair enough, Nikunj, and I think the buyback tax was only to close the gap, the arbitrage which was available because of dividend distribution tax. So now, if you take a relook at dividend distribution tax, and if that is removed and dividend is then taxed in the hands of the recipient, which necessarily does not lower tax burden. In fact, if anything, I think the tax burden goes up depending on the details. Then the buyback tax has lost its meaning, and therefore it will also be removed, logically speaking. So I think the buyback tax should not be viewed as anti-rich measure as it's being talked about. I think that was only to close arbitrage that was there. If you go back years ago, the government had introduced DDT on debt funds. That wasn't done initially when first-time dividend distribution tax was brought in, and it was done, later on because people realized in the government that there was an arbitrage between bank fixed deposits and debt funds, which was hurting bank fixed deposits. So I think that was the reason for the buyback tax. I mean, the surcharge on the super rich, and we discussed it last year as well. I think, very clearly the finance minister said last year it's not a permanent move, it's a temporary move because of the shortfall in resources. So again, I think if it remains a temporary move, and if it's reconsidered in whatever time frame that they are suggesting, then it will get reversed, right? So, I buy your point that you want to actually be subservient or paying attention to the entrepreneur, because the entrepreneur is the one that's taking risk and creating jobs, and I think he's the most important, or he or she is the most important person in economic prosperity. And I hope that that gets its due attention. We've heard this from the Prime Minister as well, and we've seen the actions of the past few months. I think the entrepreneur is back. He's back in consideration. So I think that spirit should be expected from the budget, and I'm expecting that to continue.
Now let's talk about assumptions, Ridham, because the assumptions of tax collections have gone haywire. In your report, you mentioned that there is a 56% drop in the collections. So given that there is an economic backdrop and we will be in for a slow recovery, for FY21, what do you think should be a reasonable tax or a revenue assumption?
So again, I think obviously this year is hurt because there was a very big change on corporate taxes in terms of rates. But GST revenues are actually picking up and finally stabilizing and looking like they are going to be over the six-figure mark now on a sustainable basis. So that, I think, is a good indicator. And Nikunj, I'm just stepping back for a moment. If you look at high-frequency data, a lot of them seem to have put in a bottom in the October to December timeframe. And are all turning up, including industrial production, which hit an all-time low in October and is now coming back from there. Now, I'm not saying that the economy is firing on all cylinders, of course not, but it does look like the economy is bottoming out. And to that extent, I think we can hope that nominal growth next year is a whole lot better than it was this year. So maybe this year nominal growth is in the 8 handle, and next year the nominal growth is in the handle of 9 or approaching 10. And that should be the basis for computing taxes with no changes in rates. So I don't think there's any dramatic rate change coming after what has already happened to corporate taxes. So I think 10% is a reasonable assumption for nominal growth and therefore tax collections in my view. Again, this is on the presumption that there are no changes in rates. If there are changes in rates, then accordingly that number changes.
Over the years, more and more services have reached the tax bracket. 10 years ago, going to a gym or going to a beauty parlor was not taxed, but today it is taxed. Given that the economy is changing, we are becoming cashless, we are moving towards digital, do you think more and more services, especially 1 or 2 new services from the digital economy, which could be included as tax bracket, which currently are not included?
So Nikunj, that won't be a subject of debate on Saturday, because all indirect taxes are now the prerogative of the GST committee, and therefore I don't expect anything in that regard on Saturday. The GST committee will look at all these things, and I think over time there will not be a single service or good which will be outside the purview of taxation, whatever the tax rate is. I think we are heading into, over time again, say next 3 to 5 years, where the number of tax slabs reduce to maybe 2 or 3, and the tax burden in terms of the rate actually declines. And that will be a consequence of greater compliance that I think we will achieve over the next 3 to 4 years. So that will be the overall trend in this. More and more services will be included and goods will be included, and I think the overall tax rate will go down.
The difference between personal tax and corporate tax is very large now. I don't want to use the word arbitrage here because it is not an arbitrage, but again, there is a scope for tax leakage there. So looking at the fact that they moved already on corporate tax, do you think changes on personal tax are coming for sure?
So Nikunj, it is an arbitrage because there are a lot of firms in India that are organized as proprietary or partnership basis. And their tax rate now is a lot higher than a corporate tax rate. Now, hitherto, a lot of firms, small firms, I'm talking about really small firms, like the Thelawala sitting outside our building, would not set up a corporate entity. If he or she is paying taxes, would prefer to keep it as a proprietary or a partnership firm, because there are there's a pretty long list of compliance that you need to fulfill as a corporate entity. So the minute you do that, you are getting into higher costs. But the arbitrage now is significant for a lot of people to reconsider the structure under which they want to operate their businesses. And I expect a lot of small and micro enterprises which were not operating as corporate entities to look to actually become corporate entities. And to me, actually, this is a very big formalization move. In fact, this is bigger than what DMON or GST achieved. The tax arbitrage between a regular firm, a non-corporate firm versus a corporate firm, is pretty large enough for people to think that, let's become corporate entities. So I think actually, I'm sticking my neck out, but over the next 12 to 18 months, it's quite possible that corporate tax revenues surprise on the upside because compliance levels go up, because people become more formalized in their structures due to the tax arbitrage. And I don't know how long that sustains, but it's unlikely that personal tax rates drop to the corporate level in any foreseeable future. So there will be this arbitrage that will continue, especially at the highest end of the tax bracket.